In a single week in July 2026, a company most Americans have never heard of released a piece of software that wiped out America's lead in artificial intelligence. It was Chinese. It was free, and Wall Street noticed immediately. The model is called Kimi K3, 2.8 trillion parameters, the largest open model ever built, and by the numbers it traded blows with the best that America's biggest labs could offer at roughly a third of the running cost. When it landed, chip stocks fell. The main index of semiconductor companies had one of its worst weeks in more than a year. For a few hours, Nvidia even lost its crown as the most valuable company on Earth. And here is the strange part. This was supposed to be impossible. For 4 years, the United States had been building a wall, a set of rules designed to stop China from getting the very chips you need to train a model like this. So this is not really a story about one model. It is a story about your money. Because when the world splits into two separate technology stacks, your savings do not get to sit this one out. You're already holding one side of it. Who sells the chips? Who eats the ban? Who gets rich when the world's two largest economies decide they can no longer buy from each other? That is the map we are going to draw. Here is the uncomfortable part. If you own an index fund or a retirement account, you already own the American side of this war. You never chose that. It happened quietly, while these companies grew into some of the largest holdings you have. This is the AI Cold War, told the only way that actually explains it. Not as a flag-waving contest, but as a money map. Let's start with the wall. To understand the split, you have to understand what a chip ban actually is. Training a frontier AI model takes tens of thousands of specialized processors running for months. And the best ones in the world are made by one American company, Nvidia. So in October 2022, the United States did something extraordinary. It told Nvidia it could no longer sell its most powerful AI chips to China. Not tariff them, ban them. The blacklist itself is a weapon. Huawei was cut off back in 2019. Its main chip maker, SMIC, at the end of 2020. To be named on that list means the world's best manufacturing tools are simply closed to you. The rule, written by an agency called the Bureau of Industry and Security, drew a performance line. Any chip above it, aimed at China, needed a license, and the license would be denied. It caught Nvidia's flagship chips instantly. The logic was simple. Advanced AI is dual use. The same chips that train a chatbot can design a weapon, run a surveillance state, or break encryption. Washington decided compute itself was a national security asset. Nvidia's response was clever. If the rule was a line, it would build a chip that sat just underneath it. A slightly slower version, legal to sell, designed specifically for the China market. It called them the A800 and the H800. For about a year, that worked. China kept buying, Nvidia kept selling, and the wall had a door in it. Then, in October 2023, Washington slammed that door shut. The updated rule banned the workaround chips too. It stopped measuring one thing and started measuring another. So, a slightly slower chip no longer counted as compliant. The message to Nvidia was blunt: stop designing around us. And the rules never stopped moving. In January 2025, Washington sorted the entire world into tiers, deciding which countries could buy how many chips. For months later, before that framework even took effect, a new administration tore it up. Even the rulebook was unstable. And this is the pattern that repeats through the entire story. Washington draws a line. Nvidia builds right up to it. Washington redraws the line. A cat-and-mouse game, with billions of dollars riding on every move. Which brings us to the chip at the center of this whole war. After the 2023 ban, Nvidia built one more China chip, cut down to be legal. It was called the H20. The H20 was deliberately weakened for training, but it was still an Nvidia chip, and Chinese companies bought it by the billions of dollars. For a while, it was the compromise that kept everyone in business. Then, on April 9, 2025, that compromise ended. The United States told Nvidia the H20 now needed a license too. In practice, that meant a ban. And the cost of that one sentence shows up in Nvidia's own filings. Within days, the company warned investors it would take a charge of up to $5.5 billion. That is what happens when a product you already built becomes illegal to sell. The chips, the materials, the orders you committed to, all of it turns into a write-down. The final charge came in at $4.5 billion. But the write-down was only the visible wound. In that same quarter, Nvidia had $2.5 billion of H20 chips it simply could not ship. Finished revenue, frozen by a rule. And looking ahead one quarter, the company told investors to expect roughly $8 billion of H20 sales to vanish. $8 billion of demand that existed, that China wanted to pay for, gone. And Nvidia was not alone in the pain. Its smaller rival, AMD, took its own hit, writing off around $800 million on a China chip called the MI308. The ban did not spare anyone in the business. You can even see it in the margins. Nvidia's gross margin, normally in the low 70s, fell to about 60% that quarter. One export rule, carved straight out of the most profitable chip business on Earth. So how much of Nvidia's business was China? Really? At its peak, China was about a fifth to a quarter of the company's data center sales. A huge and hugely profitable slice. And then it collapsed. On the company's own numbers, China fell from around 20% of total revenue to about 9% in a single year. The wall did exactly what it was built to do. Nvidia's chief executive, Jensen Huang, put it more bluntly than any filing could. We went from 95% market share, he said, to zero. At the moment, he added, we are 100% out of China. Now, a market that big does not just disappear quietly. Huang estimated the China AI chip opportunity at around $50 billion a year and growing. That is a number no company walks away from without a fight. So in the summer of 2025, the two sides cut a deal that had never been done before. The United States would let Nvidia sell the H20 to China again. But there was a price. Nvidia and its rival AMD agreed to hand the United States government 15% of their China chip revenue. Not a tax passed by Congress. A cut paid straight to the Treasury in exchange for permission to sell. Think about how strange that is. A private company paying the government a slice of its foreign sales to unlock an export license. Analysts could not find a single precedent for it in American history. And the 15% was itself a negotiation. The initial demand, reportedly, was 20%. The wall had become a toll booth, and the only question left was the size of the toll. By 2026, the toll booth had a new gate. The United States began allowing a more powerful chip, the H200, into China under volume caps and an even larger government cut. But even that came with a catch. A senior export official told Congress in July 2026 that so far, very few shipments had actually happened. The permission existed. The chips mostly did not move. And when the H20 was finally cleared to flow again, the numbers were tiny. Across its entire fiscal year, Nvidia booked only about $60 million of H20 sales under the new licenses. The toll booth opened, and almost nothing came through. Which raises the obvious question. If the wall is this tight, how did China train Kimi K3 at all? Part of the answer is uncomfortable for Washington. The wall leaks. Banned chips have been flowing into China through a gray market for years, rerouted through neighboring countries, relabeled, and resold. And the enforcement cases give you a sense of the scale. In early 2025, Singapore charged 3 men in a case that prosecutors linked to Nvidia chips headed for China. The transactions in question were worth around $390 million. The geography is always the same. Chips land in Singapore, Malaysia, or Thailand, then quietly cross the last border into China. So Washington started forcing those countries to pick a side with permit rules of their own. In the same probe, authorities seized a single luxury home worth about $42 million. That is the profit margin on moving chips that are not supposed to move. Then came the bigger fish. In late 2025, American prosecutors shut down a smuggling network they said had moved at least $160 million of restricted Nvidia chips. And the economics are staggering. Reporters traced a single Shanghai distributor moving around $400 million of banned Nvidia systems. Whole server racks, changing hands for up to $500,000 each. The wall is not just leaking. It is a business. And in 2026, a co-founder of the server maker Supermicro was charged in what prosecutors alleged was a $2.5 billion diversion scheme. The company's stock fell about a third in a day. But the individual cases are just the seizures. The real number is bigger. One respected research group modeled the total and estimated that roughly 660,000 of Nvidia's chips had been smuggled into China through 2025. 660,000 top-tier AI chips. By their estimate, that is close to a third of all the AI computing power inside China. The wall is real. It is also porous. Governments know it. Countries like Malaysia, long a favorite waypoint, started requiring special permits just to move American AI chips across their borders. But every plugged hole seems to open another. Smuggling, though, is a stopgap, not a strategy. And Beijing understood something early. If America was going to cut off the chips, China would have to build its own. So it did. The name to know is Huawei. Blacklisted by the United States back in 2019, it became China's answer to Nvidia, with a line of AI chips called Ascend. The latest Ascend chip is not as good as Nvidia's best. Independent estimates put it at roughly 60% of the performance of Nvidia's H100. But 60% of a chip you can actually buy beats 100% of a chip you are banned from owning. And China found a way around the performance gap. Brute force. Huawei's flagship AI system, called CloudMatrix, wires 384 of its chips together into one giant machine. On raw compute, that system actually beats Nvidia's comparable product by roughly 2-to-1. The catch is that it does it by using far more silicon and drawing around 4 times the power. China is trading efficiency for independence, and the customers followed. As Nvidia chips got harder to buy, Chinese giants like Baidu, Tencent, and ByteDance started turning to Huawei's Ascend instead. Huawei planned to build hundreds of thousands of them. Behind Huawei sits the factory question. Every advanced chip has to be manufactured, and China's most advanced chip maker is a company called SMIC. SMIC is on the American blacklist too, cut off from the best manufacturing equipment. And yet, in 2025, it posted record revenue of more than $9 billion, up 16%, building the chips China can no longer import. SMIC pulls this off with a workaround. Borrowed from the one machine that prints the finest circuits, it runs older tools over and over to fake the same result. It works, but at lower yields and higher cost. China is paying a premium to stay in the game. None of this is happening by accident. In 2024, the Chinese government created a semiconductor investment fund worth about $47.5 billion, larger than its 2 previous chip funds combined. And that government fund is not a one-off. It is the third and largest of its kind, a rolling national bet on catching up that now runs into the tens of billions of dollars. China is not trying to win next quarter. It is trying to win the decade. And China's tech giants open their wallets. Alibaba alone committed around $53 billion to AI and cloud over 3 years, more than it spent in the entire previous decade. The domestic stack is being funded on a scale to match America's. Baidu built its own chips and its own models. Tencent wanted to spend even more and then ran into the same wall as everyone else. Not enough chips to buy. In China, the constraint is rarely money. It is silicon. And when a government pours that kind of money into an industry, investors follow. Which brings us to the single most spectacular stock in this entire story. A Chinese AI chip designer called Cambricon. For years it lost money. Then the bans hit, its customers had nowhere else to turn, and its revenue exploded more than 450% in a single year to its first ever profit. In August 2025, its stock became the highest price share on China's entire mainland market, briefly worth around $80 billion. The American ban did not just hurt Nvidia. It minted a Chinese champion. The symbolism was hard to miss. For a moment, that chip stock became the single most expensive share in all of China, worth more per share than the country's most famous liquor giant. A chip designer dethroning a national icon. So China had its own chips, its own factories, and its own money. What it did next was the part that truly rattled Wall Street. It used all of it to build models that were cheap and good and free. The company that started the panic was DeepSeek. In early 2025, it released a model that matched the American frontier and claimed it had trained the base model for under $6 million of computing time. And the efficiency claims kept getting harder to dismiss. A peer-reviewed paper put the training of DeepSeek's reasoning model at under $300,000 of computing time. Not the whole story, but a genuine shock to Silicon Valley's math. Now, that number is disputed, and rightly so. It covers one training run, not the research, the staff, or the chips behind it. But even the honest version was a shock. Near frontier performance, at a fraction of the spend everyone assumed was required. And DeepSeek did not stop. Through 2025, it kept shipping upgrades and kept cutting prices, at one point roughly having the cost of running its model. The message to American labs was relentless. Whatever you charge, we will charge less. It kept the pressure on with engineering, not just price. Late in 2025, it shipped a technique that cut the cost of long tasks roughly in half and handed the savings straight to customers. Every American lab had to answer it. Then came Kimi K3, the model we open with. Built by a startup called Moonshot, backed by Alibaba and Tencent, and valued at around $20 billion before the release even landed. Kimi K3 did the thing everyone feared. It went toe-to-toe with the best models from America's top labs on coding, on reasoning, and it did it at roughly a third of the cost, with a weights release for anyone to download. Just how close was Kimi K3? On one respected leaderboard, it landed third in the entire world, behind only the very best models from America's top two labs. Third place, from a company most investors had never heard of a year earlier. And because the weights are free, China's open models now sit underneath a huge share of the world's AI usage. When your competitor gives the product away, cheaper stops being a strategy. It becomes a weapon. And this is where the losing the race headlines come from. Because the gap is measurable. Stanford tracks the quality difference between the top American and top Chinese models. At the end of 2023, that gap was more than 17%. 1 year later, it had collapsed to 0.3%. Not gone, but close enough that the word lead started to feel generous. But before you call the race over, look at what China still cannot do. Its chips are years behind on manufacturing. Its factories run at lower yields. In the hardware that actually makes the models, the gap is still wide. Put a number on the hardware gap. America's best factories run at high yields. China's most advanced lines, by many estimates, still struggle to make a working chip half the time. That difficult, unglamorous manufacturing is the moat America has left. So the honest scoreboard is split. On software, on models, on cost, China has nearly caught up. On the silicon underneath, America and its partners are still ahead. The race is not one race. It is two. And that split is the whole investment thesis. Because if the world is dividing into two technology stacks, the only question that matters for your money is, which companies own each one? Start with the American stack, because it is the one you probably already own. At the top sits Nvidia. And here is the twist the headlines miss. Losing China barely dented it. In the same year Nvidia was written off in China, its total revenue still grew from about $130 billion to $216 billion. The rest of the world bought everything China could not. And the scale is almost hard to believe. Even without China, more than 2/3 of Nvidia's sales now come from American customers alone. The company did not shrink to fit the wall. The rest of the world grew to fill it. That is how a company loses its second biggest market and becomes the first business ever worth $5 trillion, which Nvidia did in October 2025. The wall costed China. Everyone else made up the difference. Under Nvidia sits the company that actually manufactures the chips, TSMC, in Taiwan. In 2025, its revenue jumped more than 30%, riding the same AI wave. The American stack runs through a single island, and the allied stack is being physically rebuilt. TSMC is pouring tens of billions of dollars into new factories in Arizona. Samsung is building in Texas. The West is trying to drag the choke point back onto home soil. And behind TSMC sits the one machine China truly cannot replace: the extreme ultraviolet lithography system, built by a Dutch company called ASML. It has never been allowed to sell that machine to China. Not once. Even ASML was not fully immune. China rushed to stockpile its lesser machines, and for a stretch, China was more than 40% of ASML's sales. Then the newest rules cut even that back toward a fifth. That single restriction is the choke point of the entire war. It is why China's factories are stuck a few generations behind, and why the American stack, for now, still owns the top of the pyramid. And the demand feeding all of it comes from a handful of American giants: Microsoft, Amazon, Google, and Meta. Together, their spending on AI infrastructure is staggering. In 2024, the Big Four spent about $226 billion. In 2025, around $410 billion. For 2026, their guidance points to roughly $725 billion. Look at just one company's plan. Amazon guided to around $200 billion of spending in a single year. Microsoft, near $190. Each of these is a country-sized budget, aimed at the same handful of chip makers. That is the engine. $750 billion a year, flowing from American tech giants, into Nvidia, into TSMC, into the whole allied stack. This is the side of the war you are invested in. On the other side sits a stack you mostly cannot buy. Huawei is not really investable from the West. SMIC and Cambricon trade in China, largely closed to foreign money. The China side gets rich too. You just are not invited. And do not mistake China for the loser in this fight. It has a card of its own, and it plays it hard. The world's advanced factories, including the ones building your chips, run on rare earth minerals. China refines around 98% of some of the most critical ones. And when Washington tightens the screws on chips, Beijing tightens the screws right back on the minerals. Over 2024 and 2025, China restricted exports of gallium, germanium, and a list of rare earths, materials America's own defense and chip industries depend on. The chip war has a mirror image, and America is on the wrong side of it. And the timeline is deliberate. Gallium and germanium restricted in 2023. 7 rare earths added in 2025. Then, after a summit between the two presidents, a pause. The minerals are a valve Beijing can open and close at will. Beijing has other levers too. In 2025, Chinese regulators ruled that Nvidia had violated the country's anti-monopoly law and quietly told Chinese companies to stop buying its chips altogether on security grounds. For a stretch that year, Nvidia sold effectively zero H20 chips into China, not because Washington blocked it, but because Beijing did. Both governments, for opposite reasons, wanted the same wall. And part of that zero was self-inflicted. After Beijing's warning, Nvidia simply halted H20 production altogether. A chip that Washington had finally allowed, that Beijing no longer wanted. Caught, once again, between two governments. Which tells you where this is really heading. Not toward one side winning, but toward a deliberate, permanent split. Two stacks, two supply chains, two sets of national champions, built to survive without each other. So the biggest question in technology comes down to a simple disagreement between two men. Did the wall work, or did it backfire? In one corner, Jensen Huang of Nvidia, who has lost the most. He calls the export controls, in his words, a failure. His argument: the ban did not stop China, it just handed the market to Huawei and lit a fire under Chinese industry. Nvidia knew that line was dangerous. Hours after its chief executive said China would win the race, the company walked it back. China, it clarified, is only nanoseconds behind America. Even the messaging is a tightrope. In the other corner, Dario Amodei, chief executive of the American AI lab Anthropic. His view is the opposite. The controls are working, and they are, in his words, even more existentially important now. Slow China's chips, he argues, and the West keeps its lead. And Amodei's nuance matters. Even he admits China's cheaper models are real, roughly 7 to 10 months behind America's best, not the impossible overnight leap some headlines claimed. The gap is small, but is not zero. One man sells the chips and wants the market back. The other builds the models and wants China starved of compute. And the entire policy of the United States is caught between them. None of this is new doctrine. A former Commerce Secretary once put the whole policy in a single line. On matters of national security, she said, "We do not negotiate." That sentence is the wall, in 7 words. For an investor, though, the verdict matters less than the direction. Whether the wall works or not, the world is still splitting. And a split world is not a cheaper world. It is a more expensive, more duplicated, more fragile one. There's a cost to all of this that shows up on no single chart. 2 of everything. 2 supply chains, 2 chip industries, 2 sets of standards, built in parallel and paid for twice. A split world is not a bargain. Which brings us back to you. You cannot easily buy the China stack. But through your index funds, you almost certainly own the American one. Nvidia, TSMC's customers, the hyperscalers, sitting quietly in your retirement account. So you are not a spectator in this Cold War. You are a shareholder in one side of it, and only one. And the other side is the hard part. Huawei you cannot buy at all. China's champions trade in markets most Western savers never touch. So who actually profits? Here is the uncomfortable math. If America stays ahead, you gain slowly. If China closes the gap, some of the largest holdings you own take the hit, and you own nothing at all on the winning side. There is no hedge for that. 2 stacks, 2 futures, and the only outcome that fully protects your retirement is a wall that never falls. Not a winner, not a peace. A Cold War that simply holds for as long as you are invested. That is the bet already sitting in your account tonight.